All right, everyone. I want to say welcome to everyone who's joining us today on our Legacy Builder webinar series. I'm really excited to talk about the topic today. We're going to talk about, is a real estate correction coming in 2024? This is a hot topic that I get questions from investors all the time. I feel like half or more of the phone calls that I've been having with our existing investors and with our potential investors, they're all asking, what do we think about the economy? What do we think about interest rates? What do we think is going to happen next year? So I'm really excited to dive in, give you my opinion, give you our opinion over here at Headway, and why, even though the headlines are reporting some certain stories, some good, some bad, why we are still very bullish on the opportunity to invest in great assets that can help you build and protect your wealth. So let's dive right in. Before we get started on the topic, if you want these slides, if you like what you see, if you like the data, just shoot us a text, 281-559-7061. Shoot us a text with just say, hey, I'd like these slides, shoot me the slides, and we will make sure we get those slides over to you within the next 24 hours. Just a quick disclaimer, this webinar is for educational purposes only. It's not legal or investing advice. So please consult with your attorney or CPA, obviously, before you make any type of investing decisions, but this is strictly for educational purposes only. A little bit about us, talking about Headway Capital. If it's your first time here, I want to again say welcome. If you are somebody who's been here before, I do want to say welcome back. I tell you a little bit about Headway Capital and when we got started. So Headway started in 2018, and we were designed to build and protect the wealth of busy professionals. We provide investment opportunities that give you, the high net worth investor, the busy professional, the opportunity to do what matters most by generating passive income. So we have lots of experience sourcing, vetting different types of alternative investments, with our specialty being commercial real estate with a focus on multifamily real estate. And we also have some other asset classes in our portfolio, but multifamily real estate is our bread and butter. We've seen a few different market cycles, and we've been around for some time. Our company was founded by Sid Shamim and Anam Omer. They are a beautiful married couple. They started Headway Capital in, like I said, 2017, 2018. But before that, they had a very large single-family portfolio of houses, over 30 houses that they were managing here in the Houston area, which is where our firm was based, and decided that enough was enough. They had built up enough cash flow and net worth from their single-family houses that it was time to get rid of the headaches that come along with single family investing and graduate, so to speak, into multifamily investing, into commercial investing. And they started doing that by first being a passive investor. So if you're on this webinar, if you're on this call and you have interest in being a passive investor, that's how most people get started. And the rest is history, I guess you could say. Since then, we'll talk a little bit about the portfolio Headway, but we've been able to acquire over 3,000 units. So had some success in the field. We also have our CFO and CIO, Umar Nakvi, who's not on the call tonight, but he helps manage our business and help make sure that our numbers are where they're supposed to be, which is really important in any type of investing decision. And then you got me. Just a quick background about me. So I'm a born and raised Houstonian. I've lived here my whole life. I love Houston. I love Texas. And I got into real estate in 2017 on the single family side. I think I bought my first investment, if I'm not mistaken, early 2018, but started learning about it in 17 and started hunting for my first deal. I didn't know what I didn't know. And like most people, thought that buying residential single family rental houses was the way to go. So I started doing that. I got my first house. It took me probably about 6 months before I got the confidence to really make that first investment. And I was able to grow my portfolio, small portfolio, much smaller than Sid and Anam, but I had a handful of houses. And again, just quickly realized a light bulb moment went off that I was cash flowing. I'll use that term very lightly, but my money was all going right back into the houses. We had plumbing, we had leaks, we had roofs, we had AC units that had gotten damaged. I had an AC unit that got stolen. So I was dumping a bunch of cash into the homes even after I bought them. It wasn't really cash flowing. So I was like, man, there has to be a better way. There has to be a better way to cash flow. There has to be a better way to build passive income. There has to be a better way to build my net worth. Me being at the time late 20s, early 30s, I knew there had to be a better way. And I was looking at everybody else and looking around and seeing, what really connected them, what were they doing? And all the people that were experienced were all moving to commercial real estate. So went down that rabbit hole and got educated, in a mentorship group. Was at a smaller boutique private equity firm for a couple of years and met Sid in 2020, 2021, and eventually came over to Headway earlier this year, and couldn't be more excited to be the director of investor relations and providing our investors with white glove service, which is what I think we all expect anytime we write a check and give somebody our money. So excited to be here. If you ever have any questions about us or Headway, feel free to reach out. We'll have our contact information at the end. A little bit about our track record, as I kind of alluded to, a little over 500 million assets under management, which equates to a little over 3,300 units. We target a 25 to 30% average annualized returns, which means once you include the cash flow that you're going to get on a monthly or quarterly basis throughout the life cycle of the deal, plus the profit sharing that you're going to get, the proceed sharing, I should say, the profit on the exit when the property finally sells at the end of the business plan. When you combine those all together, we try to annualize 25 to 30% average annualized return, with the very baseline being 20% on the low side. So we really don't like touching anything that's below 20%, but our real target is 25 to 30. And what that essentially means, if you multiply, our business plans are typically 5 years. So if you multiply 20 times 5 on a kind of baseline scenario, that's 100%, which means our goal is to double your investment within 5 years. So we try to exceed that, but base case scenario, we want to double our investors' capital that they put in. We do have over 430 active investors here at Headway Capital. So if you decide to join our private investor club, there's already a large group in there. We're excited. We have a lot of repeat investors that have trusted us with their hard-earned capital, and we couldn't be more grateful for them being partners with us. A little bit about how we work, how we like to produce results. We're really big on staying focused and being purposeful with all of our decisions, all of our cash, all of our expenses. We're very selective when it comes to spending cash for our properties. We want to make sure our investors' dollars are maximized. So we're very purposeful with our decisions. We stay very disciplined. We stay within our box. We follow our business plan, and we be consistent. We show up every day, but we make sure that we hire people that have the same mindset. And this is our secret sauce. This is how we produce results here at Headway Capital. So let's dive right in. We're all here to talk about potential, let me open this up. There we go. We're all here to talk about potential recessions next year. Let's talk about data. I'm a big data guy. And if you're not a data person, that's okay. This might be a little nerdy for you, but I'll try to explain it as best I can. I'm not an economist. I'm not an expert, as I like to say. But I will do my best to try to interpret it and give you my opinion and my explanation on what we're seeing in the market, what I'm seeing in the market, because you cannot, and I'm going to highlight this throughout the presentation multiple times, you cannot just read the headlines. If you just read the headlines, you're not getting the full picture, because as we all know, we've all heard of, fake news and like all the stuff that was being thrown around a few years ago, regardless of whether you're buying into that, or you believe that or not, what's that a political party you're on. The headlines are written with intent, right? Their job is to get you to click. Their job is to get you to read. They're not always telling the full story. And as you've probably seen before, you can go to 2 different websites that are both reporting the same news, but the headlines are almost opposite, right? So you got to be very selective, and you got to kind of, I always say, peel back the onion when you see a headline, when you look at something. You really want to understand the data and try to make investment decisions, whether you're talking real estate, you're talking your equities portfolio, or any type of investment, business investing. You got to really understand the data, because it gives you more confidence when you make a decision. So let's talk about some of the data and some of the stuff we're seeing and I'm seeing in the market on a daily basis. Some real estate related, some not, but they're all connected. The first thing I want to talk about that we've seen a lot of this year, which I think is very telling of where we're at in the economy, regardless of what you're reading in the headlines. We'll talk about GDP and all that here in a second. But we've seen corporate bankruptcies in the U.S. They've risen over 30% in the past 12 months, right? That's not a good thing, right? So even though we're seeing words like resiliency being used to describe the economy, we're starting to see some companies, some names and we'll talk about those here in a second, and then some smaller companies you've never heard of file for bankruptcy. And that is a time of that tells you how expensive it is to operate a business right now. We all know about the cost of materials, the cost of labor, the cost of your input costs. It doesn't matter if you're selling goods or services, things are more expensive. But what people also forget about with businesses is most businesses have some sort of leverage. They have some sort of debt on their books. They're using capital, they're borrowing capital to grow their business, right? Well, when interest rates go to where they are now and money is really expensive, these businesses often can't service their debt, right? And that's why you see things like filing for different chapter 7, chapter 11, different types of bankruptcy, right? So this chart's very telling over the past 12 months. And we've seen some big brands, in my opinion, pretty big brands, not the Walmarts and the Amazons necessarily, but some of these are legacy brands that have been around for a really, really long time, right? And Cornerstone Research, there's this great quote that I found that says, the surge in large corporate bankruptcy filings in the first half of this year is consistent with economic conditions posing heightened bankruptcy risk for highly leveraged companies. So as I mentioned, companies that have debt, especially if it's irresponsible amounts of debt, a lot of debt, maybe they've been using debt to sort of keep their lights on, they're filing for bankruptcy, right? So we've seen Bed Bath & Beyond. That's a place my wife used to love to go and get home and kitchen equipment before the Amazons, right? You've got Rite Aid, which are more like a Walgreens or CVS if you're here in if you're here in Texas. They filed for bankruptcy. A lot of theft going on in a lot of those stores, right? People are stealing things because they can't afford them, and these are stores that are easy to walk in and out of with small goods and packages. We all know about SVB, right? Silicon Valley Bank, and what happened to the banking sector. I think that was earlier this year, February, March, right? And then one I wasn't so familiar with, but when I started reading about this headline was Jenny Craig, who's been around for a long time, right? In the weight loss program, a very popular household brand, same thing, filed for bankruptcy, right? So corporate bankruptcies and the fact that they're increasing at this level that you see here in the past 12 months, I think is very telling of where we're at in the economy. The second thing I think is really, really important to talk about is U.S. manufacturing. We're seeing really weak U.S. manufacturing, lowest since 2020, right? So this chart, which I pulled from Bloomberg from the Institute of Supply Management, is a U.S. manufacturing index, and it shows that we're at the near weakest level since 2020. So we have declining orders and slower production growth. So all that essentially means is companies that make things, that produce things, they're not doing that right now. It's drastically slowing to what we consider under the level 50. Above 50 is an expansion, means we're usually in a pretty good place in the economy. Companies are producing things. Below 50 is considered a contraction in the market, a contraction in the economy, right? So we're below that 50 mark right now. And these types of things, this chart is from a few days ago. These types of things that we're seeing, they're going to rear its ugly head in 6 months, in 12 months, in 18 months, right? Manufacturing is slowing down. That's not necessarily a good thing, because if demand picks back up for certain products, well, what happens when supply and demand, when there's low supply and high demand, well, that can potentially cause price increases, which could cause inflation. So it's just something to keep an eye on, but very telling that the manufacturing data is slowing. Another thing in the headlines that I think a lot of people are talking about, that I think is really important to be aware of, is where we are as a country, as the United States of America, how much debt we have on our books. Now, it's not uncommon that the U.S. has a lot of debt. I would say, it's not like, the previous regime or, 10 years ago, there was no debt. We always have debt, but the record amount at which the debt is growing is what is causing concern for people. So I pulled this from today just so I can get as accurate as possible. This website has like a ticker, and it essentially just constantly runs up based on government spending. And right now we have 33 trillion with a T dollars, billion, sorry, $33 trillion of debt, which equates to right around $101,000 of debt per person that's in the United States. That is insane, right? So that's an insane amount of debt. It's a record amount of debt that we're starting to see, and it's growing at a rapid pace. So this is something to be very wary of, because if the U.S. economy racks up too much debt, well, they have to service that debt. And when they service that debt, they have to pay interest. And when interest rates are really high, well, that's a bad thing for the economy. So they are highly incentivized, the government is, and the people that manage their finances, to see interest rates comes down, which we'll talk about here in a second. The spending deficits are also a problem with the U.S. economy right now. So I pulled this. This is from an article a couple of weeks ago, but I pulled this today. It says the U.S. wraps up fiscal year with a budget deficit near 1.7 trillion, up 23%. Now, I'm going to allude to this again, or highlight this again. This is actually very common that the U.S. has some sort of budget deficit. There's only been 5 years in the past. I think I saw 20 years or something, or 30 years where the government hasn't. But again, it's not so much that there's a deficit, but it's a fact of how fast that deficit is adding up. I saw some reports today that said that if we don't control our spending, that we could have up to 1.4 trillion of debt deficit of debt and a deficiency by the first quarter alone next year, right? So it's really important that we're watching the government spending because it has an impact on what we on our lives on a daily basis as Americans. It has an impact on our investments and has an impact on real estate, right? And you can see here on the right the interest payments on this debt quarterly, right? So it's just an insane chart. Now, some of this is really old, back from the 70s, but, kind of focusing your attention, say, from, 2015 to 2020, the interest payments that we're paying on the debt that the government has is insane, right? And they have to find a way to repay that debt. This can't be a never-ending thing. So the question is, and I don't know the answer to this, is how do we fix this, right? How do we cut the deficit spending? How do we spend less money, and how do we be more fiscally responsible as a country? And how do we, the debt that we do have, how do we get rid of it? And how do we get rid of it quickly, right? Without necessarily exposing everyday Americans to massive tax gains and different things. So I'm not a politician. I don't know the answer to that, but it is something very concerning and something to keep an eye on. The other thing I want to talk about, and I was talking a little bit earlier about not reading the headlines and maybe being a little aggressive here, but that's okay. I'll be opinionated. I'm calling it the false GDP. So last week, some reports came out that, and I love these headlines, that the U.S. GDP for quarter 3 was 4.9%. I want you to look at these headlines, right? Annual pace 4.9%. Resilient U.S. economy. U.S. economy growth accelerated to strong 4.9. U.S. economy delivers blockbuster performance in third, right? So we're talking about all this stuff just a second ago that's going on with the government. We got banks going through crises. I didn't talk about the bank stimulus program that has been extended once and probably going to be extended again, that banks need stimulus cash kind of behind closed doors that they're borrowing to kind of stay alive. We talked about, we're not talking about jobs today. There's a jobs report coming out tomorrow, so keep your eyes peeled. There's interesting data about the amount of people that have part-time jobs today. It's at a record high. All the jobs that are on the market are part-time jobs. We talked about the debt. We talked about the interest. There's all these different things going on with the economy, but the headlines are all saying that this is amazing. The government, the blockbuster performance of GDP. Well, let's look at this 4.9% a little bit deeper. Let's peel back the onion. And that 4.9%, what I want to highlight that, you really got to look pretty closely is that 0.8% of that 4.9% was actually government spending, right? So that's the government spending money on things. I'm not going to call it falsely propping up GDP. That would be, something somebody could maybe claim, or it's an opinion. It's possible to think that way, but they were spending money, right? So they definitely stimulated the economy one way or another. 0.8% of that, and 1.3% of that 4.9% was also inventories. And what does that mean? So what that means is that 1.3% of that 4.9% was companies spending money stockpiling inventory, right? So that leaves the remaining, if you subtract, and that's a very abnormal thing. It's normally not that high. So if you subtract that, we had about 2.8% GDP growth when you take out the government spending, which is not that aggressive amount is not very common. And when you take out the aggressive inventory stackage that we see, so, call it 2.8, 3.5, somewhere around there, it's still very good for GDP. But I would argue that it is going to continue to slow. And I think, my opinion is in Q4, you're going to see a massive drop in GDP because you're not going to have these falsely stimulated numbers. You're not going to have inventories. You're not going to have government spending. And you're going to also probably see the economy slow a little bit. So it'll be something to keep your eye on. Again, is GDP really this strong, or is it sort of being propped up, so to speak, by some different markets, some different indicators in the data, right? So it just seemed really odd that we went through all quarter hanging around, 2%. You can see Q3, Q4, Q1, Q2 of this year, and then boom, we go to 4.9%. I'm not buying it based on what's going on in the economy, but again, just something to keep your eye on. Let's talk a little bit about the Fed, right? And we're going to get into real estate and investing here in a second, but I just want to make sure we kind of set the stage. Let's talk a little bit about the Fed. Yesterday, the Fed had its FOMC meeting, which it does regularly throughout the year. And I pulled these from the statement that Jerome Powell, who's the Fed chair, made. And I wanted to I highlighted a couple of things that I thought. I literally read his statement, which tells you maybe how nerdy I am with this. But I wanted to highlight a couple of sections that I thought were really interesting, that he's aware, right? So this is his statement that he gave when he was at the podium. But a couple of things here. One, he said, "We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Interesting. The stance of policy is restrictive. So it says here, we have raised our policy interest rates to 5.25 points and have continued to reduce our security holdings at a brisk pace. This stance of policy is restrictive, meaning that tight policy is putting downward pressure on economic activity and inflation. And the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rates unchanged and continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks we face, the committee is proceeding carefully. So that tells me that they're very aware that we have not seen all the full effects of what is going on, what is going to happen because of the rapid interest rates expansion that we've seen. We saw 11 interest rates over the course of 18 months, give or take, hikes over the course of 18 months. And we have still yet to see the ripple effect of the shock, I should say. I think we're starting to see it, which is what we're talking about, all this data here. But they're very aware, right? And they understand that what's going on right now is, by his definition, restrictive, which is good. We don't want them to think that we're not in restrictive territory. That gives them the mindset that they want to raise interest rates even further. So very interesting. The other thing that I thought was very interesting as well, again, just kind of nerding out, is there are market analytics data that shows, it's called the Fed Watch tool. It essentially is a prediction by people in the market on what is going to happen to interest rates over the course of the next, say, 12 to 18 months, right? So we've got this chart, and it's a little kind of confusing to read, but right now, our Fed fund rate, it's always within a band. It's between 525 and 550, right? So that's the current interest rate, right? The band that the banks which they borrow against each other. Right now, as of today, again, I pulled this earlier. I want it to be the most updated because it's changed. It changes almost every day. I feel like it was 36% the other day. Right now, there's a 40.2% probability. The market is predicting a 40.2% probability that by June of 2024, June 12th to be exact, which is the next FOMC meeting in June, that they're going to cut interest rates by 25 basis points, right? So it would go from 525 to 550 to 500 to 525. That's a 0.25 or 25 basis point reduction. The market thinks there's a 40% chance of that happening. Now, that's good news because that's showing that the market understands what's going on and that they think that interest rates are going to drop by mid next year. What I will tell you is the market has a very poor track record, and most of the time they don't get it right. So usually the Fed cuts before the market thinks they're going to. So I don't have a chart for that. I should have put that on there, but I will tell you that there's a chance that the Fed actually cuts interest rates before June 12th, and that historically speaking, the market does not have a good hit rate on accuracy. They usually miss it pretty drastically, and it's usually way earlier, right? So I found this data very interesting. So in my opinion, and we'll talk about our opinions and our stance in real estate investing here in a second, but in my opinion, sometime before June of next year, we're going to see our first interest rate cut. Now, it's not going to go from 525 to 550 to 3. And everybody's high-fiving because it's not restrictive anymore. I think it's going to be gradual, right? I think you're going to see 25 basis points, pause, 25 basis points, 25 basis point, pause. Yeah, I think they're going to be very slow about cutting rates, right? So it is interesting to see that they think, and you'll see that here in the market. They're predicting July 31st, which is the meeting after June. There's a 33% chance that they don't cut rates again, that they stay in that 500 to 525. So again, the market is predicting there's a 40% chance that there's a rate cut in June, and they're predicting a pause after that in July they don't cut again. But there's an equal chance, another 33.1%, that they actually think it cuts again. So the market's quite unsure. They think after that June meeting, there's either going to be a pause or another cut. But it seems pretty telling what the market is predicting, and we're going to find out if it's right. I also want to talk a little bit about the S&P 500 because I think it's really interesting. The S&P 500 spiked with no rate increases and only 25% of another hike. So when the FOMC meeting happened yesterday, November 1st, the market reacted. This is how the market reacted, right? As soon as it found out, the S&P 500 got very excited. And I think it's just very telling, right? So the market is also predicting that the Fed is not going to be able to hold these interest rates for much longer, and they like what they're seeing, right? So I think it's very telling, because even though we're in real estate, we're not in equities. I'm not an equities expert. I do keep an eye on the market, especially the S&P 500, in your treasuries and different things, to see how does the market react when this information comes out. So tomorrow, the November 3rd, Friday, there is unemployment data coming out, job data coming out tomorrow. So keep an eye on the S&P 500 tomorrow, because when that article gets released, it's going to be really interesting to see what happens to the market. Let's talk a little bit about real estate. I want to transition and start talking about commercial real estate and real estate in general. So really interesting what's going on in the market. Demand for commercial real estate is at 2008 levels. Wow, I mean, it's crazy, right? To think that the demand for real estate has dropped that far that fast. And if you look at this chart, I mean, it almost took a complete nosedive, right? In December of 2021, and then January and February, that was really the peak, because the Fed did its first rate hike in March of 2022. So if you didn't sell your asset by the end of 2021, if not the first quarter of 2022, you started to get squeezed a little bit, right? So it's really fallen off a cliff, and demand for commercial real estate loans is at a 2008 level low. Again, just really telling where the market's at. We're also seeing commercial real estate debt, people applying for debt notes as well. The lowest in nearly a decade, right? So just a massive change. You're seeing it from quarter to quarter, the amount of commercial outstanding real estate loans, debt that people are interested in, right? We're also talking a little bit about the state of the real estate market. Fundraising is a really interesting topic as well, because we're in the fundraising space, right? We work with, and this is real estate specific, we work with private investors. We work with high net worth investors, doctors, attorneys, lawyers, physicians, engineers, C-suite executives, business owners. And real estate fundraising activity has fallen off pretty drastically as well. You'll see this chart here. Look at what happened coming out of COVID. 2021 had a massive boom, right? And now it falls all the way to 200, right? So this data is very telling about the amount of billions of dollars of private real estate capital that's being raised. You go from 600 billion in 2021, right under it at least, to right around 200 billion in 2023, and the year's almost done, and things typically slow down this time of year. So this just tells you that investors they're holding on to their cash. They're being more selective with their types of investments, which I think is really smart, right? You have to be very selective right now when the economy is where it is. So we're going to talk a little bit about that, more about real estate here in a second. But the types of fundraising that's being done, again, really interesting to see, because there are deals happening. People are still buying real estate. It hasn't completely hit a wall. But what type of deals are people buying? We talked a little bit about there's $200 billion of private real estate capital that's been raised from investors like you. Well, where's it going? Right. So you'll see here, there's really some asset classes, just to kind of break it down and dumb it down. Value add is really our bread and butter. So you're probably familiar with the term, but value add is essentially properties, usually C or B class, could be newer A class 2010 and under, that really need some work. They have some operational challenges. They have some cosmetic challenges. They're ready for a refresh. It could be 1970s, 1980s, 1990s, 2000 product, and they have a value add opportunity, right? Where you'll see that orange piece of that value add in 2023 is drastically different than what you saw in 2021, when value add was the craze, and really throughout 2016 to 2019, value add was really popular. Right now, the only deals that are really getting done, or the majority of deals that are getting done, you'll see are opportunistic. Well, what are opportunistic? So when I say A, B, and C class, I like to call opportunistic the D class. It's the stuff that make you a little nervous when you write your check and invest. Partly because of location, partly because of asset quality, but really these are risk-adjusted opportunities, meaning they're much more riskier than value add and core, but they have higher upside, right? So high risk, high reward. And those are the deals that are getting done right now. And my guess is those are the deals that are distressed, or those are the really old buildings. They're falling apart. They're 50% occupied. They're beyond value add. They are opportunistic. And it takes a very special person, a very special operator, a very skilled operator to really go in and turn these properties around, especially under this current environment. So those are the only deals getting done. Core deals are essentially going to be your inner core, inner city product, typically very new product. think 2010 and up, really new, nice assets. Not a lot of that going on. Core plus, and then core is like your A class, new construction, 2023 build, 2022 build. I don't see any color on that chart. If I zoom in, maybe you'd see some, but there's not a lot of that stuff happening. So the only thing really selling right now are value add and opportunistic deals. Talking a little bit about the residential side of the market, U.S. home prices actually are still rising, which sounds crazy because supply and demand are so out of whack. But this article is from today, or this week, I should say, the 31st, that showed all of August's data, and we're still seeing strong residential price growth, even though that we had a record high for the last 10 years in interest rates. They're back down now. They're about 7.5%. But a few weeks ago, residential mortgages hit about 8%, which is just insane. I bought my house at like 2.75 or 3%. I don't know what you have yours at, but there's a number. I believe it's 60%. 60% of all mortgages for primary residents in the United States right now have a low interest rate. I believe it's sub 5%, if I'm not mistaken. So the fact that rates are at 7.5 to 8% right now just tells you the market is frozen. And when the market's frozen, prices can't go anywhere, right? Usually they don't go up or down, but right now we're still seeing prices creep up a little bit. And that's partly because people still need to move and they still need a place to live. And there's not a lot of inventory on the market, right? So we're still seeing prices creep up a little bit. I predict they're going to kind of flatten out and drop a little bit. But it is interesting to see that there are still price increases going on, not at a drastic rate that we saw, obviously, coming out of COVID, but there's still certain markets that are seeing some positive growth. And it is, the thing about real estate is it's hyper local, right? So this does not apply to every market. This is strictly talking about the U.S. as a whole. Saw a small 2.6% increase in August. And I will say August is one of the busiest months for residential real estate. And that's because people are moving in summer. May, June, July, August are your hottest months for real estate, residential real estate. So not surprising to see a slight increase in August. My prediction is that when you see September, October data, you're going to see that number decline pretty drastically because the activity is going to drastically slow down. So what does this all mean, right? We talked about a lot of things. We talked about GDP. We talked about inventories. We talked about manufacturing. We talked about bankruptcies. We talked about commercial real estate being down. We talked about residential real estate being flat. Not a lot of demand going on. What does it all mean? And to me, what it means is that opportunity is coming, right? The market that we are currently in feels and is showing a lot of the same signals that we see typically during a recession, and definitely a lot of the signals that we saw prior to the 2007, 2008 great financial crisis, right? Now, what tipped that market is going to be very different than what tips this market over. In 2008, it was subprime mortgages. It was lenders giving out mortgages to residential home buyers that were not qualified. They gave out too many mortgages. They packaged them up and they went out and sold them. And they realized whenever the recession hit that these mortgages were worth nothing. Nobody wanted them. Nobody wanted to buy them. People literally handed their keys back on the homes because they were giving out what they called ninja loans: no income, no job, no assets. If you had a pulse, you could go buy a house. I know people that bought a house with no money down and got paid at the closing table prior to the great financial crisis. Insane times, right? You could go buy a commercial real estate building. You can go buy a $5-10 million building and bring 5%. Right now, it's absolutely impossible to do that, or it was, at least, especially today, but it even was coming out of the great financial crisis. You're not seeing those types of terms anymore. So that's what tipped the 2007, 2008 great financial crisis. What is going to tip whatever we end up calling the potential recession, assuming we go into one, if we're not already in one this year, next year? I'm not quite sure what it is. Interest rates are definitely going to break what is going on. And it might be because of interest rates, because the Federal Reserve has a history of hiking. And when they hike, their track record is they almost always overshoot and hike us into a recession. You hear a lot of talk about things like soft landings. That's a very common term that you hear. They're trying to achieve a soft landing. And all that really means is that they're trying to hike us, bring down inflation, keep jobs stable without going into a recession. Well, that is very, very, very challenging, and they do not have a great track record of doing that. Historically, they almost always miss. So, in my opinion, opportunity is coming based on all the economic indicators. I think we are going to go into a recession. How bad that recession is, it's really hard to tell. But I think we're going to go into a pretty serious slowdown. And what the message I want to leave you is that we have to be prepared, because what's going to happen in the real estate market is already starting to show its head. And what does that mean? Let's talk about distressed assets. And this is where we're getting really excited at Headway, is we're starting to see distressed assets coming to the market. It's a little trickle, a little drip, as if you had a faucet on. It's not fully flowing quite yet. You just get a little drip, a little drip here and there. But we're starting to get phone calls and hear rumblings of operators that have distress in their portfolio. They bought in 2019, 2020, 2021. Their properties aren't cash flowing. They paid too much. Their interest rate was floating. They didn't have a interest rate cap. And they're at a point now where they're either underwater or they're close to being underwater. And a large majority are not meeting their debt covenants. And what does that even mean? Debt covenants are basically the rules you have to follow when you borrow money from the lender. It says how much revenue you have to bring in, what is your debt service coverage ratio, how much revenue over how much expenses are you bringing in? Are you meeting your debt yield? Meaning, are you providing profit? There's a lot of different variables you look at. And if you don't meet those covenants, that's lined out very clearly in your loan documents, the property could be taken away from you by the lender. Now, we have not seen a lot of that. We've seen some flexibility so far in the market, but we are starting to hear and see signs of distress. Now, lenders don't like to take back properties. They're not in the business of property management. But if they feel like the property is going to be lost anyway, they'd rather take it back and get something for it versus getting nothing for it. So they can take it back. They obviously will own it much cheaper than you own it. They're buying it for only for the the value left on the debt. So if you paid 20 and they gave you a loan for 10, well, they basically got that property for 10. And then they're going to go and resell it, right? They don't want to hold on to it. So they're going to come and resell it. And that's where we want to be. We want to be the people they call when they resell it. But we'll talk about that here in a second. But you'll see this data, and I pulled this chart from TREP from today. This report came out this week. Is you're starting to see delinquency rates in different types of property types. So I think this is really interesting. And I wanted to highlight, we really focus on multifamily in our market and here in Headway. And you're seeing in September and October, you see that spike up right there. I'm going to be watching this chart very, very, very closely, because so far things have been very flat. I mean, look at January to September. That line is pretty close to flat on delinquencies, right? So people are still paying their bills. They're still paying their mortgages. Not a lot of default going on. Of course, there's some big headlines that have happened, but there hasn't been a ton yet. Well, we just saw that first uptick in October of this year. So last month, basically a few days ago, this data came out, right? It will be very, very interesting to watch what happens to these lines over the course of the next 12 to 18 months. You're seeing some stuff on here that is already really telling. Office, we've all heard about office, is obviously in the most distress. There's hundreds of billions of dollars of office loans that are coming due that with people that have office buildings that have no tenants. This is going to be a huge mess. You're also seeing lodging. So that's a big one as well. And retail is also something that is pretty high up there on the list. You'll see that all the way up top. Retail is another one to keep an eye on. Too much retail that was built at floating rate debt. They have construction loans. They just can't pay back their loans. They don't have tenants that are moving in, right? So we'll be watching this very closely, and I suggest you do the same. This is from TREP, TREPP. Other headline that I saw today, again, just kind of highlighting the same thing, is we're tracking, the multifamily delinquencies, right? Apartment owners are starting to struggle to pay their lenders. So that's basically what I was telling you at this chart here. We're starting to see that. So again, just something to keep your eye on. And another big one that I think is really important to watch is we are seeing a drastic amount of constructions stop. So this headline also from TREP says multifamily construction starts down 60% in Q3. Well, why is that important? Why do I care about multifamily construction? You guys buy existing buildings. Why does it matter? It is really, really, really important that you understand the domino effect that multifamily construction slowing and stopping has on existing inventories. It's actually a good thing. So when there's not new buildings popping up and new properties popping up, where are people going to live? In the existing buildings, right? So when you see construction stop, that's going to rear its head in a good way in 12, 18, 24. It might even be 3-4 years down the road where when the market picks itself back up and we're not in a recession, inflation isn't high, interest rates are back down, the economy's back to normal, and people start moving again and they're more confident, they're going to start looking for places to live. People move. It's very common, right? The average lease is 12 months. Well, if they haven't been building multifamily, they stop building it, they slow down their building, there could be some markets that are undersupplied, right? Based on the need from tenants. That's going to make existing assets even more valuable from a valuation standpoint when you sell them. And it's going to make them more expensive when you buy them. And it's also going to lead to better occupancy where you have less competition if you're not seeing new properties pop up left and right, right? So this is something to keep an eye on. You don't want, it's not a good thing when the entire construction market freezes because it's going to have a long-term ripple effect on the commercial real estate space, especially on the multifamily space, because people need a place to live. So again, another thing to keep your eye on. The other thing is values, right? Why are people distressed? So we're talking about distressed here. We talked about properties values dropping. I pulled this from Yardi Matrix. So every month they come out with a national multifamily report. It's free to download. You can go to yardimatrix.com, download it yourself if you're interested. And this is an excerpt from last month's report in September. This is the newest one out there. It says multifamily property values have dropped at least 20% based on cap rates. So what that means is that properties are dropping in value, right? And that's not a good thing for people that say they bought in late 2022, early 2022. Values are dropping, right? And when values are dropping and you can't service your debt, that's a problem, right? So if you're not a strong operator and you don't have a lot of cash in the bank, you can get in a situation where you might need to sell versus wanting to sell. So again, values are coming down on multifamily, and I think that's a good thing because honestly, they were overinflated. They grew way too fast coming out of COVID. Multifamily was never this expensive prior to 2021 coming out of COVID. So they're falling back down to where they should be, which means we're gonna get an opportunity to buy things at the price we're supposed to be paying, not overpaying for properties. So again, a good thing, but it's going to cause some distress. It's going to cause a little bit of a mess for people that overpaid. So distressed purchase opportunities are coming, right? I've already mentioned that a few times, and I think it's really important that we understand that the best time to buy something is when it's on sale, right? We all like to shop. We love Black Friday. We love Christmas shopping. And what are we always looking for? No matter how much money you make, everybody wants a deal, right? And we all know, we've learned, we've been trained being in real estate long enough that the price you pay for something is so crucial, right? It doesn't matter what your forecast is and what your pro forma is, but you got to make sure you buy things at a really good price. Not everything can be 50% off, but you got to pay market value or under, right? You don't want to overpay for a property. But in my opinion, everything is about to go on sale, right? I think we're already seeing property values down 20%. Some markets are less, some markets are more. Certain asset classes are less, certain asset classes are more. And I think with the current interest rate environment and inflation that we're still seeing, that we're still fighting, and demand for commercial real estate overall going down, I think a lot of properties are going to be able to be bought at an extreme discount. And one of the things we're preparing for here at Headway is we are forming relationships with brokers, of course, that get access to these deals. And we're forming relationships with other institutions that are involved in these transactions that can give us information, give us wind of any types of distressed deals, because we want to come in and we want to buy these properties. I'm not going to say for pennies on the dollar because that would be a little bit of a stretch, but we want to buy them at a discount, right? We want to pay a great price for still a quality asset, because the things that we're noticing in the market is that they're solid deals, good vintage, meaning they're built 1980s, 1990s, 2000s, great markets, Houston, Dallas, San Antonio, great locations, some great buildings in great areas, highly occupied. We're seeing assets that are 90, 92, 93, 94, 95% occupied, but still can't pay their mortgage. Well, these are great buildings, right? There's nothing wrong with them. They're in a great market, great area, great occupancy, ran really well, but the sellers got to sell because they overpaid and they can't afford their debt. Well, if we can come in, if the bank takes it back, or if we can come in and save the day and buy it at a discount, and they might take a small loss, or they might have to break even, That's where we want to be. We want to be able to buy things at a discount, buy them on sale. And we feel like that opportunity is coming. So, how can you make these investments with us, or how can you make these investments with other firms and make sure you're being safe, right? That's my number one objective. I would love if you partner with us, invest with us at Headway. But if you invest with another firm or somewhere else, whether it's in, residential or commercial or whatever you decide to invest in, how do you safeguard your investment if you're investing in commercial real estate? Well, the first thing is by understanding that you need to be making smart, risk-adjusted decisions, right? You need to be running your investments through a filter. And if you don't have some sort of filter like this, it's really a mental exercise. Then you are going to put yourself at risk for making a bad investment, especially right now when the market's going to be choppy. There might be some deals that look amazing, but if you're not running them through your filter on the things you should be looking for, you might end up investing and regretting it, right? So first thing, we'll just run through this real quick, is target market. Where's the deal? Where's it at? If it's not in a great market, I don't want to touch it, right? Personally. Location, is it an A class, B class, or C class area? What risks are associated with that location? Really important to pay attention to. What asset class is it? Or is it an asset class you're interested in? Don't go get shiny object syndrome. If you love multifamily and that's where you want to put your money, stay focused on that. Or if you at least I always tell people, pick a couple, right? Maybe it's multifamily and industrial. Maybe it's multifamily and car washes. Maybe it's self-storage and mobile home parks. Whatever it is, whatever your thing is, focus on your asset class. You can't be a jack of all trade. Is there an opportunity to increase NOI? That's really important. You need to make sure you're buying something that has a value add opportunity so that you're not buying something that you can't increase the value on. Really important. Who's managing it? Really important. We are going through a recession or about to go through a recession. You need to make sure that the management firm that is managing the asset where your money is going knows what they're doing and knows how to ride the market cycle, even though there might be tough times ahead. What's the business plan? What are they doing? What are they planning on? Is it feasible? Does it make sense? Who's doing it? Who's on the team? Great questions to ask. And then the last thing are just some basic numbers. What are you paying for it? What do you plan on selling it for? What's your entry cap? What's your exit cap? Does this sound realistic, right? Does it sound realistic that you're going to sell a property in 3 years that you pay a 6 cap for, that you're going to sell it at a 5 cap? I don't know. Is it that the cap rate drops? Maybe, maybe not. You need to ask yourself that question and ask yourself, do some due diligence on that, right? So you need to make sure that expectations are realistic so that you're not investing in something that's going to be hard to sell because you overpaid for it 3 years ago, 2 years ago, right? So just run your investments through this checklist, a 7-step filter, and it's going to help you safeguard your commercial real estate investments. And then how can you find them, right? How do you find good investments today, especially what's going on in the market? You got to stay active. You got to talk to me. You got to talk to other operators. You got to talk to other people investing in real estate, friends, family, anybody that's in real estate. You got to find private sponsors like us over at Headway. You got to find somebody who understands the market, who understands the data, and is going to be a good fiduciary of your capital. You obviously got to have you got to have an application filled out and be ready to invest. And you got to schedule a call with me or whoever you're deciding to work with to go over our track record and make sure you're able to move quickly when deals are finally open for investment. So quick questions for you before we wrap up and take some Q&A. Are you looking at the data versus reading the headlines? Again, we went over a lot of headlines today, some good, some bad, but make sure you're always peeling back the onion. Do you have a list of vetted sponsors that are looking to take advantage of the next cycle? You need to be talking to people that see what's going on in the market, that are being opportunistic and ready to take advantage of these discounted properties. If you talk to somebody and they're like, oh yeah, the market stinks, I'm not doing real estate anymore, that's not somebody you have a lot of confidence in. You want somebody who's sophisticated, who's savvy, who's not just reading the headlines, who understands that opportunities are coming. And then are you finally going to be ready to invest in these discounted properties in 2024? You got to be ready. You got to have cash ready to go. You got to, if you have a self-directed IRA, or if you don't have a self-directed IRA and you want to get one started, you can reach out to me. I can connect you with one of our third-party custodians. You got to make sure you're ready, right? Because when these opportunities come to buy a discounted property, 20, 30% off at a great price, it's going to produce great cash flow. People are going to see it. And even though we're in tough times and people are still nervous, they're still going to fill up, right? So you want to make sure you don't miss out on that opportunity. So you got to be ready to invest. So be getting your cash ready, be saving, be ready to invest however you planning on investing, whether it's to your IRA or you're paying cash or you have an LLC, be ready to rock and roll. So we have obviously opportunities here at Headway. We really focus on distressed apartments, multifamily in particular. We've got our income fund, if that's something you're interested in. I'll talk more about here in a second. And then we really like car washes. If you haven't spoken to me or you haven't invested with us, I do see some of our existing investors on here. So thank you for being on here. Hopefully you learned something. If you're not a part of our private investor club, I would highly recommend that you get with me so you can apply and we can get you on the list. By joining the club, you'll gain access to our in-person events. We do have an in-person event coming up this upcoming Saturday. It's a property tour for our investors. So if you're not signed up for that, please reach out to me afterwards. I would love to invite you to our property tour. It's at 10 a.m. On Saturday here in Houston, Texas. We are touring one of our assets. We also have our educational webinars and then exclusive passive investing opportunities. Obviously, you got to submit an application and talk to me and be a qualified accredited investor. So here's the link or the QR code, I should say, to apply to be in our private investor club. If you take a quick scan of this, if you have a moment, I can also send you the link afterwards. And then if you're interested in our income fund, so if you got some cash sitting on the sidelines and you're ready to invest, but you don't know where to put it right now, we'd love to talk to you about our income fund. This is essentially a hard money debt fund that we go out and loan money to investors that are flipping houses and buying rentals. They're short-term 6-month loans with high interest, and we're able to arbitrage the difference and pass that on to our investors. It has a $25,000 minimum, pays a 6% return from $25,000 to $99,000. Anything $100,000 or more gets an 8% preferred return. No upside, just cash flow, and it does have liquidity, so you can pull your money out within 30 days notice. Usually we'll give it to you back usually within 30 days, but we do need a written notice. So really important. If you want to learn more, scan that QR code. If you have any questions, let's go to Q&A. But if you have any questions, feel free to reach out to me privately. And of course, if you want these slides or you want to join our private investor club, scan that QR code at 281-559-7061. You guys can text us if you want these slides. But let's go through some Q&A. We are getting close to our time, so I'm probably only going to take a couple of questions here. Let me scroll through and try to see if I can find some good ones. If you have any questions, please put them in the Q&A box. I'll try to see if I can get through them here in the next couple of minutes. Let's see. Do you think the Fed is going to raise interest rates again? Oh, I think I kind of hinted toward that. Maybe I didn't come out flat and say it. My answer is no. I don't think they're going to raise rates again unless data comes out that says they need to, right? So right now, I just told you, obviously I nerd out on data. I don't see enough for them to aggressively decide that they want to raise interest rates again. Can they? Yes. What would cause them to do that? Well, if they see an uptick in core inflation and the data goes in the wrong way, if they see massive job growth and the job market doesn't slow down, there's a lot of reasons that could cause them to continue to raise interest rates. But I personally think we are in the pausing cycle. And I think sometime before June of 2024, or I should say by June of 2024, we are going to see some sort of rate cut. And historically speaking, I will tell you that the rate cuts come unexpectedly. Most of the time, they don't give you like a little flag that says, hey guys, we're about to cut interest rates. It's almost unexpected. I mean, I've looked at past market cycles where this has happened. And, today is Thursday. They'll be putting out press releases, and the people that represent the different Fed chairs will be saying like, oh yeah, we're not cutting interest rates. We got to stay aggressive. We got to be strong. Rates are still high. We're not cutting them. And then literally the next day, a press release comes out saying they're cutting rates. So it happens, right? So it's going to come unexpectedly. We're not going to be able to predict it. That's why I said that June numbers are sort of arbitrary. From a track record standpoint, it could come anytime. So great question. What type of assets are you looking for in today's market, and what would get you excited? I think is what that says. So we are looking for distressed multifamily real estate. And that's why I am so excited and so eager to talk to our investors, especially those that have not invested with us before. Our bread and butter is value add multifamily. That's where we cut our teeth. That's what we build our entire portfolio on. We're really good at turning properties around, and we're really good at running these tougher to manage properties that require renovations. So if you haven't talked to me before and you're not, we've never chatted, and you want to invest in discounted real estate deals at cash flow that we can turn around and flip together a part of the business plan, then you need to get with me. But those are the types of deals we're looking for. Distressed multifamily deals. I would say typically, ideally 1980s and up, although sometimes some of these older deals still make sense. 60s, 70s are not ideal. There's some different electrical and plumbing stuff that makes those a little challenging. But we definitely still look at those. But 1980s, 1990s, 2000s and up, distressed, that's ready for a value add opportunity, that is a great asset and a great location. I mean, sign me up for that all day. We ideally, the cap rates have changed a lot in the last 18 months really. But we're looking for something where we can get a great deal, right? So if we can buy something for, properties already dropped 15 to 20% here in the Houston market, but if we can buy something another 10, 15% off, well, buying something that was at a 30%, 35% discount compared to what it was in late 2021, early 2022, that feels really good, especially because we're very confident in our operations, and we're very confident that, remember, we're holding these properties for 3 to 5 years. We're very confident in that 3 to 5 year window. We're going to be able to ride through the market cycle because we're savvy and we understand how to run these properties, and we're going to come out ahead, and all investors are going to be very happy. It might be a little slow at first, especially when we acquire these properties, but we're going to come out strong, and we're going to, whenever the market starts to turn, you're going to be able to feel it, and you're going to be very happy you invested. So we are on the hunt for these types of deals. And if you know anybody that has a deal like that, please feel free to reach out. But we're always looking for these types of deals and talking to investors who are interested in investing in discounted properties that we can take advantage of. So that is, let's see, I think, did I see any more questions come through? Nope, I think that's it for today. So kind of short and sweet today when it comes to the questions. So I guess hopefully I did a good job. I want to thank everybody for attending today's Legacy Builder webinar. If you have any questions, feel free to reach out to us at investor@headwaycapital.us, or you can email me directly at brian@headwaycapital.us. Again, if you want these slides, text us at 281-559-7061. I want to thank you for tuning in. We'll catch you on the next webinar. Have a great day.